All right. Another wild one. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. I'm out of both PayPal, got to my $70 target, and TTD after the close. Into the pot. Into the pot. Where is that TTD? Oh, nice. A decent fill on it. Okie dokie. What another crazy day. What a crazy day. Where to begin? So we gapped up this morning about 0.5%. Into the close, we had positive news. After the close and after the 8 p.m. after hours, we had positive news. In the close, we talked about it yesterday, so I don't need to go over it again, was the semiconductor news. And then after hours yesterday, we got the announcement that there was going to be a trade deal done with Great Britain. And then pre-market this morning, we saw rumors that that trade deal was going to still include the 10% tariff on British goods. So that is still in place. That turned out to be correct. And yeah, we got our first trade deal done. I kind of thought it was going to be a sell the news event. Was my original thought process. So again, you can see pre-market we're grinding up. I probably logged in just after 5 a.m. and I started really adding to my shorts closer to 6. So I got some pretty good prices on some shorting that I put on in the pre-market hours as I was doing some research on my own, where I learned something I didn't already know, which is that the United States already had a trade surplus with the UK. So my thought process at that moment was like, wow, we're gapping up really big on a trade deal that seems like it should be the most easy layup trade deal possible because we already have a trade surplus with them. Seems pretty simple. And on that, I thought it might be a sell the news event. And it seemed like it was going to be that way in the pre-market price action. You can see us grinding down, I think, as more people realized what I was realizing with my own research. And then at the open, while we still had a gap up, we were kind of weaker in the beginning of the day up until the announcement really actually occurred. So it was supposed to be at 10 a.m. Trump was like 45 minutes later, 50 minutes later, so it didn't really end up going off until 10:50. Now, before I talk further about the price action post trade deal, got to bring up again the systematics. So originally, pre-market, I'm doing my research and I'm like, man, I really want to lean into this on the short side. I think it's going to be a sell the news event. The deal itself, the information of the deal is important because it sets the stage for everybody else. And I think I'm of the opinion that seeing that we're still going to be doing 10% tariffs on Great Britain, and then Trump basically said this himself later in the deal in the day, means that the best case scenario for any country, any deal, is going to be that they end up at a 10% tariff rate. That's the absolute best case. And I actually don't think it's a great thing. Personally, I think everyone knows I'm very against tariffs for economic reasons. And it'll be really interesting. Like, I'm expecting, I said this in the morning meeting, that we get a deal done with Switzerland that gets announced probably on Monday or Tuesday. Switzerland's another one that should be super, super easy because Switzerland has had 0% tariffs on the United States prior to all of this. So it'll be really interesting to see a country that had 0% tariffs even to begin with, if we're still going to put 10% tariffs on them as well. It looks like the answer to that is going to be yes. So unless Switzerland is like, no, I refuse to do this deal because why are you charging me 10% tariffs when I'm charging you nothing, I would expect to see another layup of a deal done with Switzerland because we're going there. The United States is going there this weekend, and it should be a relatively easy one. So that was my initial thought process. Sell the news. And then we started seeing more of the data from the systematic bid, and it's insane how much they're scheduled to buy, like over the course of the next week. So they're scheduled to buy like almost in any tape, like, and I saw this confirmed in a different research note as well. Bill gave us just like the one potential 1 day worth of buying chart pre-market, but $30 billion is the number it looks like from now through a week from now, from what's today, Thursday, so Thursday through Thursday next week they're set to buy $30 billion. So it's just a huge number. The CTAs are buying, the buybacks are fully buying, so the underlying bid in this market is going nowhere. Yet despite that, we were able to see some degree of weakness in the beginning of the day. You almost would wonder what this would look like if the systematic bid wasn't there. So it means that there was somebody out there who was thinking, hey, this is a sell the news event, and was dumping stock into the initial move. And then we got the deal. And not only do we get the deal, deal helped give us a bid, but we really got, what I called in the VTF a Trump pump on the market today. He was hitting us with seemingly good news left and right. Unlike what he said yesterday, where he said that there's no way I'm bringing down tariffs on China to below 145%. He then later said maybe there's room to bring it down. He said that today. That helped some of this pump. He said a deal with the EU pretty soon is probably going to be likely too. That helped with this pump. Heck, at one point he said it looks like a great day to buy stocks or something like that. Which that, in some ways, I feel like that statement alone was probably enough to rattle the market further to the upside, because does anyone remember the last time he said it's probably a great day to buy stocks? The SPY, I'm guessing, was trading at $4.95 at that point and closed the day at $5.50. So of all the statements he was giving, he got his deal done. So we got the victory lap there. He got, the EU is coming soon. China, maybe I'll lower them down, and then later we saw, I think it was from the New York Post, saying that maybe the number is going to be 50% that we drop China down to. So anyway, all that really helped to give this market a nice bit higher, and we extended into 570. 570 is the level that I was discussing $50 ago, $50+ ago, that I felt was where we could get to on a positioning squeeze, and it has now been fully achieved. And there might even be room for even further higher prices, because, like I was just saying, we know that the systematic bid is not going anywhere, at least over the course of the next week or so. And at the same time, the hard economic data is still looking pretty good, and that might change next month when we see May numbers that start to reflect the tariffs a little bit more. But that's obviously to be determined. So I then felt it really seemed to me like, and I think I said it into the VTF, like we got this little wimpy 10-minute pullback right here that then was bought right back up, and I was like, this now feels like the floor again of that systematic bid, just really holding the market up for the entirety of the day. And then I think at about 3 o'clock, I postulated something that I've kind of been reading about a little bit, but also I've seen in recent history, where maybe we can get a sell-off into the close, because it looks like buybacks turn off at 3:30, and it looks like the systematic buyers turn off at 5:50. They don't buy anymore at that time. So that creates a window where that systematic bid's not there anymore, and real sellers that might be in the market have the chance to push this market down. 3:50. I say 5:50, 3:50 Eastern. And we've seen that here on multiple recent occasions within the confines of this like underlying bid situation, to the point where I on a couple of these days I've been short, and usually what I do personally with my swing positions into the close is I de-risk where I can. So like, it's complicated to get into the specifics of the execution on like this specific part of my cash flow strategy. But if I'm short, and I'm working like the 10-cent increments as an example that you guys know I sometimes do, and I'm supposed to have a bid at like, let's say 10 cents on the bid because I had shorted 20 cents on the offer, I'll actually bring that bid up in the last 10 minutes of the day to 19 cents. So basically I'm getting out at like break even to not make the money on it, but it just reduces risk and, for what it's worth, reduces overnight interest that I'm paying by taking a little bit extra off, kind of at like, not for a loss ever, but I could take it off a little bit more closer to break even on the piece that I had, in this case, shorted. And I remember on a few occasions here, we would get these sells in the last 10 minutes of the day after that seeming systematic bid was there, and I would just be like having bids out to cover at break even and not really be making money into these down moves. And today I was like, I bet it happens again, and this time I'm not going to do that. So I left my bids on my shorts basically where they're supposed to be, and then lo and behold, right into this last 30 minutes, the buybacks are gone. Into the last 10 minutes, it looks like the systematics are gone, and we had like a really hard sell once again in the end of the day. So it seems like the biggest thing that's holding up this market, and the thing that didn't turn this into more of a sell the news event, is just this continued systematic bid. But it turns back to what you guys have heard me say many times in the past: don't fight the flow. Don't fight the flow. That's the name of today's afternoon meeting. Don't fight the flow, because that flow is really powerful at certain points. And I said in the morning meeting, by having a good understanding of market dynamics, we have been able to call out pretty much every major market top and bottom. Not necessarily always perfectly to the actual day, but usually pretty close. Like, we've been able to call out pretty much every major market high and market low going back at least through the 2022 bear market at this point, when I started really incorporating a lot more of this information into my trading. So, at this point, it's a really weird situation because I am finding myself fighting the flow. I am finding myself net short because of the more macro picture that I have. But I know I'm too early. I know I'm too early. And I'm just like trying to hold on for dear life and manage the positions well enough that I don't lose money while this systematic bid, works its way through the market. And I've been postulating, you could even say hoping, the hoping in trading is not a good term to use, that we kind of range up here despite that systematic bid, just because of the price levels that we're getting to, in conjunction with the headline risk seeming to turn a little bit more now to the downside, and that macro environment. The flip side, though, is some of the data that we've seen where if we can continue higher, it might cause like long position chasing to come in from people who are underinvested in this market. Or I know Cody in the VTF pre-market posted a statistic that I had also seen elsewhere that showed that the IWM is like more net short now than it has been in, I don't remember the exact statistic or how long back it goes, but there's a ton of short exposure right now into the IWM. So you can get a real positioning squeeze between that systematic bid, the underexposure to longs in the market that still seems to exist to at least some degree, though albeit probably a little bit less, and the IWM people being as short as they are, because the Russell, it seems like it has the most risk on both sides right now. It's got the most upside risk where if these trade deals somehow really work out, that can squeeze the most. Highest in 5 years, referring to the IWM short flow. Thank you, Tate. Yet at the same time, if there really are some negative repercussions that hit related to tariffs, which is my expectation, then the IWM would probably get hit the most, which is probably why the short exposure in them is so high right now. So it's just a hell of an interesting market. I hate fighting the flow, even though I'm doing it right now. And it's just really interesting that once that forced bid turns off for the day, we have consistently, just scrolling back here, 1, 2, 3. This one's kind of a maybe, but I'll count it. 1, 2, 3, 4. Not yesterday. 5. Like 5 of the last 6 trading sessions, or maybe 4 out of the last 6 trading sessions, have turned into pretty big sells in that last 30 minutes or 10 minutes, depending on the situation. So yeah, I mean, that's kind of where we're at. We went from, as Pat was saying on the radio, into the close at 3:30. If this daily candle closed at 3:30, we would have been looking fantastic. There would have been a nice downside tail, like continuation hammer type of pattern into the 570 level, with us closing near highs, where the technicals really would have looked set for continuation. And now, maybe it's looking like we're getting a secondary failure off resistance, where we need to go sideways more, or potentially even break down, though a real breakdown will be very difficult given this bid that we know is still in place for at least tomorrow and throughout next week, and probably maybe after May OPEX, which is the 16th, right? I believe. Oh no, yes, right? Hold on. I don't know. Need someone to confirm it for me. What's the calendar? Yeah, I'm pretty sure it's the 16th. Maybe after the 16th, we get a little bit of a window where we begin to lose that systematic bid a bit, and people can get a bit more scared about the market and let their fears play out. But again, it's also probable that if you're really looking for a pullback, that pullback might not happen until the summer, June or July, when the degree of the strength of the systematic bid is behind us, and we begin to see, potentially, to be determined, but we potentially begin to see the implications of these tariffs more in the actual hard data. So that is, I think, where we're at from the big picture down to the small picture. As far as trading today, I got absolutely smoked in Palantir. I repeated a mistake that I could swear I did an afternoon meeting on at some point in the last 6 months, where I talked about very specifically not doing what I did, which is thinking that you can short, especially opening extension, when there's massively high volume confirmation. And that's what I did, and I got trapped, and I took a nasty loss from a day trading perspective in Palantir. I still have my swing on, but I took a really nasty loss from a day trading perspective. I just saw this extension. I started shorting kind of on the third bar when I thought I was getting like a 5-minute RDR around 115, maybe even slightly under 115 in anticipation of it. And then instead of getting a price correction, I got a beautiful time correction. The 80 EMA caught up, and then it gave continuation. And I got totally smoked on size in a bad trade. And looking at my P&L, I am negative on the day. But if I could take away Palantir, my Palantir P&L combines both a swing trade, and it was up huge, and the day trade, I would be green on the day. So all of my negative P&L comes from Palantir. Otherwise, I'd be, not a crazy fantastic day by any means, but I would be nicely enough in the green if it wasn't for Palantir. So, that's the repeat of the lesson. I get really mad at myself when I make mistakes that I know are mistakes that I have done previously. I think especially for newer traders, it's okay to make mistakes as part of the learning process. What's not okay is to repeat your mistakes. Especially, for myself, I've been doing this for a very long time. I should not be repeating mistakes that I know are mistakes. And I couldn't get that price correction to work my way out of it. Honestly, a lot of times if I get stuck into something, like it happened a little bit in Google yesterday at a certain point, but a lot of times if I get stuck in something, I can trade my way out of it. And I just was not able to trade my way out of this in Palantir. It was way too strong. I was way too early, and I had way too much size in a name that was breaking up with momentum on huge volume. And this stock is the stock for that. This is literally the stock for that, and we all know this. So yeah, just gotta lick my wounds on that one and move on. Tomorrow's another day where I can battle. This thing basically um, filled the gap from the earnings report, which is also incredible. Stock looks like it's back on course to go to $150 if this market doesn't roll over, or if the stock itself doesn't find selling into the gap fill, uh, which is a possibility. So, is what it is. Hate relearning lessons that I already know. That pretty much covers, I think, what I got. I don't think I have anything else. So, happy to turn it over to you guys for questions. Tate's given me a big something today, but I think that there was something above that. Oh, yeah. So I don't know. This is a good question, kind of from Pete and Dennis here. I don't know if today's announcement is the earth-shattering announcement, right? Trump teased yesterday that there was going to be an earth-shattering announcement. Those are his words. That's going to come out Thursday, Friday, or Monday. That's what he said. There was some speculation that it might be related to Medicare, I think, yesterday. And then today, obviously, we started seeing it last night, and then today we got a trade deal. I don't know. I didn't see any confirmation throughout the day that this is the big announcement, or if that is still yet to come. So let's just keep our ear to the ground on that. And he also had said yesterday that it wasn't necessarily on trade. So again, not necessarily means maybe, right? Maybe it's on trade, maybe it's not on trade. So I really don't know. But it's something to know, something to pay attention to. Another thing I was thinking about, just as I'm talking out loud, is after the UK trade deal is done, and we saw a further step back on China today, and a step back on the EU in terms of like, let's get some deals done. Um, I'm starting to wonder even how much good news that could be that's left in this market. And another interesting thing will be, which I was speculating about a little bit on the VTF and in the close, is what would a market reaction be to a reduction in China tariffs to 50%? Because we had read in that Goldman Sachs note just a couple days ago that Goldman, who is by no means perfect, is estimating that the market is currently pricing in a reduction on China tariffs to 40%. And what I had been saying the last couple of days is, if we see a reduction in Chinese tariffs to 70%, then probably the market gets smoked. But if you see the reduction in Chinese tariffs to 20%, then the market probably goes through the roof. So 50% would be an interesting number because it's fairly close to that Goldman number, but it does exceed it a little bit. So we would really find out if Goldman is right. And like I was just saying, I'm starting to wonder just how much good news there actually can be that's left. We have a skeleton of what these trade deals are going to look like when it comes from the UK, of probably what a best case scenario trade deal will appear to be. And if the China gets announced tomorrow or on Monday or over the weekend that we're cutting down to 50%, I'm inclined to think that gives a big initial pop that becomes sellable. Because I still think 50%, my own thought process is 50% is actually a really big problem still for the economy. Like 145%, for lack of a better term, is stupid because it might as well be a trade embargo. Like, you'd kind of just end trade. And I think that 50% is still such a huge increase that it would have really negative repercussions on the economy. So, still a lot of headlines that's going to be coming. So, a lot more big dips higher and moves lower on headlines are to be expected. And I don't know if today was the earth-shattering announcement or not, but I still got the ground beneath me. All right, I think that Tate's giving me a long one here related to this, like, 390 SMA or something that he was commenting on the pound tier short at a certain point to try to give me some hope, but it didn't work. Let me read what you have to say. I've been using this strategy as part of my intraday process, and it's built on some of the foundational concepts from Brian Shannon. I'm a big fan of Brian Shannon, so Dennis quoted him as well. Specifically, the importance of anchoring to relevant moving averages that reflect actual price memory. What I like about this approach is that it lets me stay grounded in bigger picture trend context without constantly flipping between time frames or losing focus during a fast tape. By translating daily moving averages into their intraday equivalents, by translating daily moving averages into their intraday equivalents, I can keep key trend levels visible and actionable within my trading screen. To replicate the effect of daily moving averages like the 5-day SMA, the 5 simple moving average, I think Pat uses that one, or the 8 EMA, which is one that I'm a big user of, on intraday charts, we scale them based on time. A full regular trading day is 390 minutes. So 5 days equals 1,950 minutes, which forms the basis for calculating intraday equivalents. For example, to replicate a 5-day SMA on a 30-minute chart, you would use a 65 simple moving average, 13 bars per day times 5. Okay, I follow the math. To mimic an 8 EMA on the daily chart, you'd use 104 EMA, which is 8 for the EMA, times 390, which is the amount of minutes in a regular trading day, divided by 30. This scaling gives us the ability to reference higher time frame trend structures while staying active on the intraday setups. It's especially useful in earnings plays or multi-day momentum names, helping us gauge if we are trending with strength, pulling back to key areas, or stretched away from the higher time frame average. This study is used to find the essence of trend, where price has been respected over time and where mean reversion or continuation may occur, not as a trade signal in isolation. I think that's the way with almost any indicator that you might look at or build out. However, this strategy only works well with shorter dated moving averages, like a 5 to 10 day ranges. That makes sense, just because the minutes will get a little bit crazy beyond that, right? Once you go beyond that, the periods become so large that the indicator becomes disconnected from actionable intraday price movement and starts losing relevance. In Lightspeed Trader, to prevent these long-term studies from distorting your chart scale, go into the chart setting and check scale to price only, so that the y-axis is not stretched to fit the SM. Oh, that's actually good information. I'm going to forget that in 10 minutes, though. This approach lets us trade with a daily level of awareness without flipping time frames or losing clarity during the fast intraday moves. Got it. Okay. So when we were shorting Palantir and it was building out this flag, and some traders on the team were remarking about this little push through failure here as a sign where maybe we might go down, and I was saying not so fast. I think that the only reason that happened was because of the market had a pullback there and the stock is actually super strong. You were saying like, well, we're still below the 390 moving average, so it still is potentially okay. So now I get what you were saying, at least. Really appreciate the information. I love that you're thinking outside the box. I love the concept of what you're talking about here. Of, I'm a big fan. It's a big part of my approach is to go big picture down to small picture, to look at daily charts for the idea of how I want to trade, then look at the small time frames for execution. So you're working on a way to be able to view that information more succinctly, and that I think is great. Almost definitely not something I'm ever going to put in my charts, but I think, as everyone knows, I don't really put anything new in my charts. So that's not an insult by any means. And like I do personally with a lot of information that traders provide that I don't personally have in my own charts, like RSI or different measures of the VWAP, while I'm not going to use it myself, I'll be interested to see you provide the information in real-time trading situations that many of the team are involved in as an extra potential layer of probability. So thanks for the explanation there, Tate. Yeah, these are good charts that you're posting here as well on the economic data front. I saw those somewhere. I don't remember if it was Pat's note or not. But basically, I think it's like related to hard economic data, like following the soft data. And in this current episode, it's specific to event-driven markets, which I think is interesting. So basically, what this is saying is, we had discussed. I think that this chart comes from Goldman too. We had discussed. Really, I think starting around Liberation Day or after Liberation Day, and it was based off of a Goldman Sachs note that defined different types of bear markets, and I had never really heard of that before, as event-driven, secular, or secular, and we had been saying, well, this is an event-driven market, and the question is, does that turn into a cyclical bear market, which is one where it's longer in duration than just an event-driven market, and it becomes that when you see the economic numbers themselves decline, as opposed to this event-driven market, which in some ways can almost be like a big old blip on the radar, and then you're back to trading as normal. And part of my hypothesis that has led to my bearish overall thought process for the market on the big picture, even as we're undergoing this positioning squeeze, is that the event-driven market will morph into a cyclical bear market once the data begins to hit. And the data hasn't started to hit. I think I mentioned it in the last couple of days. As an example, the de minimis tariff exemption only was squashed, I think, as of like last weekend. So you're not going to see that in any April data, but you might see it in the May data. You probably will see it in the May data, but we don't get that until June. So anyway, basically what this chart is showing is like the soft data, which can sometimes, I think, be a little bit more forward-looking versus the hard data, which we know Jerome Powell has said it, Scott Bessent has said it, is still really strong. And what it shows is that, like, usually you get soft data rolls over first before a recession, and then the hard data rolls over. And that may happen again here. But the interesting part is that the hard data has been significantly stronger than what we see in typical situations in front of a recession when the soft data is already rolling over. And it also looks like the soft data is rolled over faster than what typically happens normally. So, and then the soft data expectations right now are insane. And if anything, I would almost say that's a bull case. But yeah, so it's a great chart, that exhibit 1, and then, and I'm just trying to explain that, with words as much as I possibly can, so people who are on YouTube who can't see it can try to understand what we're looking at. But thank you for that really good chart. Scrolling through here, I think the next one's from Richard. Quick question: what makes you feel we will squeeze to 470 when we were $50 away? Like, where does the 470 target generate from? To phrase it in another way, what made you say 460? Well, so I said the range between 460 and 470 would be the first thing I would let you know. Because when I was calling it that far away, it is way more art than science. So what I was saying back then is, I think a positioning squeeze is possible to somewhere between like 560 and 570 and I called it a reach target also. At that time, I was like 550 is the huge level. But I think we could break 550, and that would even enhance the positioning squeeze, and that could get us up to somewhere between 560 and 570. At the time, it felt like a crazy call, to be honest. It felt like a crazy call. We were trading so far away from that. But where did it come from? I mean, it came from all the stuff that we have seen that have got us there, basically, which is just a thought process on knowing the data on the systematics, that there was going to be a lot of forced buying, that everyone was hedged for the left tail and no one was hedged for the right tail, and the headline risk at that time, and it's starting to lessen now, was very much to the upside. So, that combination of things and knowing that it would take time to potentially go from this event-driven market to this cyclical bear market just kind of made me like throw out those numbers. And I threw out those numbers based on where we had been previously. That's it. Just that there was a lot of price congestion from March that was in this like 560, 570 zone, and that was pretty much it. It's kind of how I came up with those numbers. You hear me say it a lot. I try to think big picture about the market because I think that the big money comes from capturing the big moves. But if you're thinking big picture, if you're thinking like a couple weeks out, a month out, a couple months out, whatever, it's very hard to do that because you got to be super open-minded to the fact that a lot can change over the course of a month. If you're making a prediction that's a month out, a lot can change, and you got to be very flexible that, like, okay, this changed, therefore that idea that I was thinking a month ago that might manifest is probably not correct, and now this is what things actually look like. But I think that the big money comes from capturing the big moves in the market, and that was the big move. It was to the upside, and I have for the most part done very well making money into this up move. It's only really been in the last handful of trading sessions where I've gotten net short that I have struggled a little bit more for obvious reasons, and I'm nervous still that squeeze has the potential to continue and to break up. But I think that time is on my side, and I actually do think that the next big move, right? If we think that big money comes from big moves, is to the downside. But I said it already earlier in the meeting. I'm too early. And I have a habit of being too early, by the way. Anybody who's been trading with me for long enough probably knows that. I have a habit of being too early. I think we got to get through more time. More time to get closer to seeing economic data hit when we're in June, and we got to get through this bid. I mean, the way that the vol control funds are buying right now over the course of this next week, it can't last that big for a very long time. It could last for a week or two, and it can continue to buy after a really big week for sure. But it could be a situation where we drop from $5 billion worth of buying a day from vol control to 500 million a day or $1 billion a day, which is still an underlying bid to the market. But when I have found that when the systematics are doing anything huge, it's the name of the afternoon meeting today on YouTube. Don't fight the flow. It's just so hard. But I think it's super interesting, and that's why we talked about it earlier, that we're getting these rollovers into the close once the bid is gone. I think it's actually very telling of the potential of a much larger sell-off, but not with this degree of forced buying still. And like I said, asking me today right now, I think that the next major move in the market is to the downside. I won't be surprised at all if this summer we retest April lows. As a matter of fact, that's actually almost my base case. I think that this summer, at some point this summer, July, August, I think that we retest, potentially even break April lows. But I'm saying what I think might happen in July and August when it's May. And we are in an environment right now where we counted it yesterday. We had 7, I think, major, and this was, we counted this before in the evening the trade deal with Britain got announced, which I'm sure moved the futures market. It did move the futures market, I looked, which breaks one of my rules. So we had 7 or 8 just yesterday alone, major news events that were market moving. So I've got this base case thought process in my head right now that is based on us getting through the systematic bid and then the hard data rolling over per Tate's chart, that brings us back down to April lows this summer. I very well could be wrong on that. I have to be mentally flexible to recognize if I'm wrong. There was a time during the COVID period, since I'm doing a lot of talking today, we can go back and do a history lesson on how Derrick traded COVID. So, if I'm going to tell the COVID trading story for me personally, I gotta tell the full thing, but I gotta try to remember why I'm even talking about this to begin with. So the reason why I'm talking about this is changing your thought process as new evidence presents itself, which for me is the number one reason to take a loss. So I actually got smoked in the down move of COVID, and I made a lot in the up move in COVID, at least the first portion of the up move in COVID. And this is, I wish, like, so much should be different, maybe not so much, but if only I knew about how the systematic funds worked back in the beginning of 2020. If only I had the knowledge that I have now about how this stuff works at that time, the amount of money I would have made would have been insane. So I have many friends who live in China because, as I've told in a previous story, there was a time, like if you go back to 2013, where my trading desk had like 30 something people on it, like let's say 30 people on it, and like 2 of them were American, 20 of them were from China, and 8 of them were from other countries, mainly like India. Everybody was like a foreign student who was joining the trading desk at the entry level, using like what they call their OPT period. And I had like this, and it was fun, and it was cool. It was a cultural experience, and I made some really good friends. And as a result of those friendships, I've gone to China a whole bunch of times because I've been invited out there to speak at conferences related to these connections that I made. Because, most of these people, I've talked about my disgust with the fact that we have the brightest people in the world from foreign countries come to the United States to get master's degrees and PhDs from our Ivy League universities, only to kick them out, and we make it almost impossible for them to stay. It's the craziest, stupidest thing ever. And I know that both Trump and Elon Musk have actually talked about trying to make that easier for them to stay, and I really hope that they follow through on that promise, because that would be a great thing for them to do. But anyway, so because of those connections I have, I knew about COVID before a single person in the United States that I know of knew about COVID in 2019. And at that time, my life changed dramatically as a result of COVID. I moved out to Idaho. I'm half the year out here. The martial arts school that I taught at for 15 years ended up having to close their business because of financial distress related to COVID. But I taught there for years and years and years and years on Saturdays. That was my Saturday, was teaching martial arts and basically running that entire business every Saturday for many years. And I taught an adult group class on Saturdays for a long time. And I remember telling people, I think at the very end of 2019, if not the beginning of January in 2020, in both on the physical trading floor, which is where we all traded at that time. That was another big difference in my life from COVID, is that we got rid of the physical trading floor. We do this virtually now. And telling people in my martial arts class, I was like, look, I got friends over in China who are saying that there's this virus that popped up, and they're saying it's bad, and people are dying, and it's spreading like crazy. And I was like, I really don't know a lot about this, but just imagine if we get one case of this seemingly super deadly virus in the United States. Just imagine what it could do. And I remember getting on the packed Long Island Railroad to go from Long Island, where I taught martial arts, to New York City, where I lived, and researching on my phone and learning about like an N95 mask. And I went to the um, like the Home Depot equivalent uh, near my apartment in New York City. It's not a Home Depot, it's something else. And they had a package of 50 N95 masks, and I bought the entire package. And this is before there was a single case in the United States. Next thing I did was I went to Rite Aid and I started buying all this canned food. And I brought all that to my apartment to be ready. The one thing I didn't buy, I didn't load up on, and ended up not being a problem anyway for me at least, was toilet paper. And I know that turned into a big problem for a lot of people. And at the same time as I did all that, I started shorting the hell out of the market. I was like, at that point, the most short I had ever been in my entire career. Because I was like, at that point, China was shut down, right? And in the United States, we still weren't really like talking about it. The market was still kind of grinding up a little bit, and China was shut down. I remember I was short. Oh man, I can't remember the name of the symbol. I probably have it blocked out of my brain. I was short a company. Is it Tripcom? Is it Tcom? Are they Chinese? Trip.com? I think so, if they're Chinese. I was short this Tcom. Yeah, look at this move in the beginning of January. I was short this Tcom in the beginning of January on size because they're like a Chinese travel agency, and you weren't even allowed to leave your house. And the stock kept going up every day. And I'm short the market and everything. And the market's going up every day. And I'm like, damn it. Like, I'm getting smoked. And then we got like a case of the United States or something. You got this little dip here in the second half of January. And we got this little dip. It helped me make a bit of money. And then next thing I knew, we were making new highs. And we were in February. And at that point, when we made new highs, this dip was because of COVID, and we made new highs. I said to myself, you know what? I'm wrong. I'm wrong on this one. I guess this isn't as big of a deal as I thought. And I can't keep getting smoked on the short side. I hate getting smoked on the short side, by the way. Like, I do much better getting smoked on the long side. I feel better about it than getting smoked on the short side. That's a psychological trading thing that I'm aware of with myself. And I stopped myself out of all my shorts for like a pretty nice net loss. And then like within a few trading sessions later, we had February OPEX hit. Feb OPEX hit on that was the 21st, right? Feb 21, I think. And that was it. What changed? What changed when the market started crumbling in the second half of February versus the beginning of February when we were making all-time highs? China was locked down. It was starting to spread in the United States. What changed? The only thing that changed was OPEX hit. We saw the exact same thing happen February this year, right? Everyone remembers the market made all-time highs the day before, 1 or 2 days before Feb OPEX of this year, and I was 100% net short. But this time I said, nuh-uh, I'm not getting pushed out of these ones this time for a loss. The market dynamics say that there's a high probability that we break down. They're not supportive of this break out, and if we can get a catalyst, the market will get destroyed. That was a learning experience that basically kind of came from COVID. So what ended up happening to me on the downside of COVID was I had no shorts. I had just taken a loss on all of them, but I had some longs on. And the longs smoked me. And eventually, obviously, at certain points on the way down, at various points on the way down, I stopped myself out of everything. But I got, like, my 2020 started very bad. I got smoked short. I got smoked long. And then, thank God, I nailed the low. I nailed the absolute bottom to the day. On this day, after having gotten stopped out of all these longs, I remember it's something I usually don't do, especially in this insane of a market. On this day, on the day of the low, into the close, I bought a ton of stuff. like all Mag 7. Apple, Microsoft, Amazon. I remember Apple specifically. And I got hugely long on JNUG. Which you can almost not even see here. I got hugely long on JNUG on this way up throughout April or so, and oh yeah, no, that was actually later. That trade was later. That was off this bottom. But anyway, I made a lot of money on that trade. I got smoked, and then this is the whole point of the story that I actually wanted to talk about is about mental flexibility. So I did really well on these longs. I mean, I bought SPY equivalent like 223.50, and the next day we closed at 244, right? And then we ripped further, had a little bit of a pullback. We gave another leg up, and then I don't remember the exact price. But somewhere in this like 270, 280-ish area, I liquidated those longs that I made a lot of money on, and I started to short. And this is actually really where the lesson came from on being mentally flexible. I started to short because my thought process at that point was like, okay, we got the Fed to come in and save the day. We got this massive overextension bounce trade. We overshot that well above the moving averages, well above what most people probably expected, and I started to short because it's like, it's great we got this bounce, but literally the world is still shut down. I can't go to a restaurant. I can't do anything. How is it possible that the market's just going to continue higher? So I got out of my long and started to short again. And, I work ranges really well, and this was a range period here, so I was able to work some range on the money and then on my positions a bit and make a few dollars. And then the market wasn't breaking down, and it was working its way back up. And at some point in here, I don't remember exactly when, it was probably, if I had to guess, it was after this May gap up when I was short, and we were making these new highs, getting above 295. I said to myself, I'm wrong. I'm wrong. I saw some new data present itself on, it was like on like M2 or something like that, like the money that was being out there that was coming from a combination of federal government and Federal Reserve stimulus at the same time. And I said, I don't think it even matters that the world is still closed like I was postulating with my thesis, initial thesis. I've got new evidence and new data that's telling me that this market is probably not going down. And I got out of my shorts. And that's like my whole COVID story. And if I didn't capture this low, honestly, like I don't even know if I'd be talking to you guys today. Like that's how dire it was after getting hit on both sides of this, and then capturing that up move, then flipping short. But you got to be mentally flexible as the new information presents itself. So the point of me saying all that was long-winded, but I thought it was kind of a cool history lesson, especially for people who are newer on the team who might not know that story, is I think that the next move on this market is to the downside. I think I'm too early. I could also be wrong. And I need to be mentally flexible enough to know if new evidence presents itself that shows that I'm wrong and that this market is working higher. And that could come from a number of places. Maybe it comes from tax cuts. Maybe, even though this is one thing I'm like super confident about, maybe I'm wrong. Maybe tariffs are great for the U.S. economy and they're going to make the economy thrive and bring us up higher. I really, really don't think so. It's like one that I'm almost willing to die on. But got whatever it is, whether it's the market dynamic information that shows me that I'm wrong or the hard data doesn't roll over in June, July, I have to be prepared for the possibility of being wrong, and then at a certain point being able to say like, all right, these shorts I have on, these are no good. Let me reposition my portfolio and kind of take it from there. But yep, very long-winded answer to your question, and I took a ton of time. But let's keep moving on. Tate saying, I swear, on the days we know that the systematic bid is in play, it's almost like clockwork. We flip right around 3 p.m. like it's scripted. Yeah, 3, sometimes 3:30. What do your executions like on Palantir? What do they look like? That's them. Talking about the USA Pope. I think it's the first time we've ever had a Pope for the United States. Pretty sure. Fact check me. What will happen after VIX expiration day on May 21st? Not necessarily anything. It just... Oh, is VIX-piration day the 21st or is it the 14th? I thought it's usually the Wednesday before. I'm not sure. I'm not sure. I'll assume that you're right, and then I'm wrong. What will happen after that? Not necessarily anything. I mean, we know that after monthly OPEX specifically, you get a lot of gamma that rolls off on the market that opens the market up to more possibilities. But this has been an interesting environment because gamma hasn't most of the entirety of the month of April we've actually been trading with negative gamma or near zero gamma. I think in the last handful of trading sessions that number has become increasingly positive by a little bit. I don't think it's a huge number like what we were seeing in 2024 that was making it so that the market literally couldn't move. But I think that gamma is increasing again and is becoming positive. So anyway, just after OPEX, generally speaking, you get a roll off of that gamma, so it makes it more possible for the market to have bigger movements. From Liam, losing my voice. Today I hesitated to trade during the Trump meeting, even though the technicals look good. In hindsight, that was a mistake. Do you think it is more important to focus on technicals, or do you think it was better to avoid trading the meeting given the heightened volatility? Learning lessons for sure. Just hate sitting on the sideline. Well, you should always be trading the technicals. An increase in volatility just means that you have to risk more space between your entry price and your stop loss, typically speaking, and therefore you need to make more space. And also, if you want to be risking the same amount of dollars, you take less size. So if in a normal environment, I want to risk $100 and it would be a 10-cent risk trade, I'd have 1,000 shares. In a higher volatility environment, I might have to risk 25 cents. So to risk the same $100, I would take 400 shares. That tends to be the difference. But otherwise, you're just trading the technicals, but you want to be aware that there's a news event occurring that's increasing that volatility and increasing the movement. And for new traders out there, one of my favorite trading session sayings that you want to keep in mind, Mark Sperling used to say it all the time, was now it's escaping me. Anticipate, don't react. Anticipate the movements that are going to occur. Don't react to the movements after they're occurring. For example, traders that like to trade a day two after a stock gave a big day one, that trader is reacting to the fact that it gave a big day one. You needed to anticipate that the day one was going to happen by being involved in the breakout, not reacting the next day when there's a worse risk reward and lower probability of success to the fact that a breakout occurred yesterday. And that's one of the hardest parts about trading because in theory, we want confirmation from the charts. And new traders think that confirmation means that the trade worked already. Like, they basically look at a trade that worked already and they say, oh, that's my confirmation, I should go long. No. Confirmation as much as possible comes from layers of probability that you're digesting on the trades that you take before you take them, as you're anticipating the move that's going to occur. You're getting your confirmation from the fact that the market agrees with your trade, that the daily chart agrees with your trade, that the relative strength agrees with your trade. All of those things come together. That's where the confirmation comes from. All right, I'm starting to get worn out, so I might need to try to do shorter answers. Let's see what else I got in here. Looks like a long one from Dennis. Sorry, longer one. Main thing on Palantir today was the break through the 114 to 116 zone. Okay. Where I have a large cluster of all breakout AVWAPs ever since we gapped up April 23rd. Okay. It had a high probability that Palantir was going to find some supply in that zone. Since we undercut that after earnings, meaning the average buyer on the up move was now well in the red. Or break the zone and settle back into it, at least from my experience, but it sliced through on big volume and on momentum. Yeah, the big volume and momentum I think was really key there. That made the short pretty sketchy already. So when we got to that 117 to 117.50, I shorted on size again cautiously. Is that when I told you that I didn't like it because of the relative strength? Or is that might have been, I think that was later in the day. Cautiously took off more aggressively, making some money back on also shorting too early. Once we held 116, I scaled out for a loss afterwards as well. Bottom line, in general, the way it came up so hot after open with volume and just disregarding the cluster where we should have found resistance, I think we got ahead of ourselves going too fast on the short. I mean, for sure, I got ahead of myself. And, you know, I barely missed out on some very important kicks on a couple small pullbacks, which also really hurt me. I was very close to getting some fills. One of them I was distracted, and that was not good because I would have raised my bids or put in a stop, like a risk-reward stop on those bids. But like this low here at 115.23, I had like a bunch of big bids basically between 115 and 115 quarter, and none of them got filled. The low was 23 cents. And I should not have given that stock all the way back to make an extra 5 or 10 cents on some of that. But, you know, like I said, it's a bad excuse, but I was being distracted by something and I just didn't hit the risk reward stop out, and then that hurt. And then it happened again, I think, on this pullback. This low was 116.26, and I had also a bunch of bids at that point between that low of 116.26 and like 115.75 or so. Like on two movements there, if I could have gotten a little bit more, it would have really bailed me out. But thus is trading. Bill saying, yeah, you're too early. I like you timing it with the hard data showing issues. Kind of thinking quarter end could possibly lead to possible liquidity issues. Varun, you don't live in India. You live in Connecticut. I do not wish we had a physical trading floor. I'm very happy to be done with that stage of my life. From Eli, do you think that new traders learn better in person versus virtually when you get to be around some of the more experienced guys? No, I don't think that they do. I don't think that they do. I really don't. It might seem that way if you've never been there, but I don't think that you do. The best part about the trading floor is going to happy hour after the market closes with everybody. That's the best part about the physical trading floor. The physical trading floor is not good on trader psychology. It is not good in terms of providing information to all the traders that are part of the team. So, we had a massive trading floor, massive, multiple rooms. We had the entire floor of the 10th floor at One State Street Plaza, and like the entire space. It was massive, and it was too big. Traders couldn't communicate information well. You would end up basically having like a handful of people around you, a few people around you that you would be able to communicate with, provided you had good people around you. And you would miss out on everything else that every other good trader on the floor was saying because they were too far away. You'd have Pat on one side of the room, you'd have Bill on one side of the room, Josh on one side of the room, me on one side of the room, and you can't hear anything that any of us are saying to one another. in the virtual trading floor, everybody gets access to the exact same information at the exact same time. So it led to like this bullshit competing on like who thinks they have a better seat, and this guy thinks he's getting ripped off because his seat isn't as close to so and so trader as that guy's seat is. Hated dealing with all that, and honestly, no one's taken the time. I don't want this to come off mean. No one's taking the time to get out of their desk to go help you and hold your hand as a new trader who because we're both on the desk to begin with. And as a matter of fact, like a couple things, like one's probably just I'm getting a little bit older, but it also helps to be able to do this virtually, where I'm able to be a lot nicer virtually than I am in person on the actual physical desk. Like, and it was just different. It was a different environment. It was very old school, but like you had to have thick skin on that desk because you're getting cursed out by somebody, probably by me. Like a couple the occasions of it's 9:32 and there's an entry level trader who's there for 3 days on a demo account who wants to come up to me on because they want to ask me a question about their demo account and like taps me on the shoulder at 9:32 to ask me a question. You're going to get a very fast reality check on what it's like to be on a physical trading floor when I turn around and start screaming in your face F words and everything else that you need to get the heck away from me and sit the F down and yell at me from your chair like a normal trader is supposed to do. Um, I saw a trader throw a chair at another trader's head one time. Um, the threats of violence that I've seen over time. I ripped a mouse out by its cord one time and I chucked it like a baseball at a trader's head. That's a true story from like 2012 or something. I'll deny it in the court system. Um, uh, this is so much better this way. Um, Everybody gets access to the exact same information. If you're a new trader, it might seem like, hey, I could be getting more if I was on the physical desk. I promise you're not. This is better. This really is better. When we did the afternoon meetings back then, this is also more efficient. I can share a screen, and everyone can be at their computer looking at the screen share. It used to be it used to be that everyone would try to like gather around behind my desk with their notebooks and try to see what I'm pointing out on this like one singular small screen that I have in the afternoon meeting. It trust me, I did that for over 10 years. I trained traders there for over 8 years. This is better, and the numbers show it too, to be totally honest. The numbers of our traders, this was one of the biggest decisions in T3's management, deciding to really go permanently remote for people, is the numbers were better. It was as simple as, oh, look at this. Traders are performing better. They're generally happier, not having to do a commute to the office. And also, there were other good things for T3's business. We can expand. For a long time, if you weren't willing to move to New York City, I wasn't willing to work with you. Now you guys can be located anywhere. So that expands the group that we're able to work with and the diversity of the people that we're able to work with. And there was one other thing I was going to say about it, but I don't remember. But just trust me. But with that said, like if you wanted to go into T3's office in New York for like a day or something, we could probably arrange for you to go in. That can happen. Unfortunately I do everything I possibly can to not go to the office, to be totally honest. But they really want me to go there like once to twice a week in the summer, so I end up going like once or twice a week in the summer. But it's terrible for me. The commute's terrible. The commute costs me money on my trading, and I hate that. I end up like city biking to the office like a psychopath, dodging taxi cabs and risking my life because I'm like worried about a market moving occurring in between the time it takes me to get from my apartment to the office. I hate it. I hate it. I'm so over it. And I'm honestly in the point where and now I'm just bullshitting me personally. I'm like kind of like getting too old a little bit for New York City. I still love it. I still love New York City. I love the East Village, which is where my apartment is. I don't want to give it up entirely, but every year that I'm in Idaho, I want to spend more time here and less time there. And that's just, I'm going to be 40 this summer, so that'll do it. Thanks for the question. Thanks, Dennis. Answer your question already, Liam. I can imagine that someone was having the worst day. Oh, and that was another thing, is that, and this is actually, I think, a really good thing from a trading psychology perspective. You don't see the people's P&Ls around you. I think that's bad when you're seeing the P&L of other traders around you. It's not a good thing. It doesn't make you focus on trading properly, correctly, and consistently over time. You're worried about what this guy's making, what this guy's losing, what this guy's doing. So that's where the bad trading psychology aspect of it comes in. You don't get that remote. This style is extremely efficient and allows new traders to be more venerable and ominous. I still know who all of you are. If you try to sneak in with a new name as an admin or whatever they call me, I could just double click on it and see who you are. But yeah. And new traders should always feel very welcome in asking questions in our virtual trading floor. That's how you improve. All right, over in the YouTube, let's try to do this quick. The majority of index daily candles close off their lows highs. Have you done a study to see if the majority of these moves happen between 350 and 4 and reconciled to this periods of when CTAs or vol funds are deemed to be buying or selling? Curious to see if this is driven off of this or maybe MOC imbalances. I've never done that study. This is something that I literally have only put together today, which, by the way, as I said that out loud, that means that I learned something new. And that's what I love. That's the thing that keeps me coming back to this business, is that I'm still learning new things. So it's something that I'm going to start paying closer attention to. I would think that, and this is just me thinking without hard data behind it, I would think that when it comes to this concept of the systematic bid rolling over into the close, not being there so when the market rolls over in the close, I think that depends on everything else that's going on. Right now we're in a unique situation where, to me, it feels like the market actually wants to go down, and that today should have been a sell the news event. But it couldn't have been because of the systematic bid. So therefore, we only saw the rollover when the systematic bid stopped. But how often is it that way? Maybe on a lot of other occasions, the systematic bid is there, but everybody else, other people want to be buyers too. So therefore, you don't get that same rollover in the same way. Appreciate the question. Last thing here is from Apex Joy. The 2020 COVID bear market was also an event-driven bear market. Yes, it was, with bad economic data showing, but the difference was the Fed and the fiscal help the markets got during 2020. We may get some later this year. Yeah, we probably will. I mean, it's clearly, it's just like Jerome Powell said yesterday. It's dependent on the data specifically related to unemployment and inflation, and how that data evolves and manifests over the course of these next handful of months. So we'll see what support we get from the Fed and when we get it. All right, I'm wrapping it up. Have a great night, everybody. I'll see you tomorrow. And if you're on YouTube, give me a thumbs up. Tell your friends.